Hello and welcome to How to Exit. Today we're here with Adam Coffey. Adam Coffey is a CEO, board member, best-selling author, Forbes Business Council member, and acclaimed business speaker. Adam Coffey is an inspiring, authentic leader who creates high-performance cultures and drives transformative growth. Over the past 21 years, he has had the honor of serving as president and CEO of three national private equity-backed service companies, each in different industries. Two of the three he built, achieving enterprise value of over $1 billion. Coffee is an active mentor to MBA candidates and is a regular favorite guest speaker at UCLA. Adam, let's just start right here. Tell us a little bit about how you got started, what got you into this space, and let's just start with that.
Yeah. Hey, Ron. Thank you for having me on. Hello to all your listeners out there. Appreciate it. Hey, listen, when I was a little boy, hey, I wanted to be a goalie for the Detroit Red Wings. If someone would have said, you're going to be CEO someday of a medical service company or something even sexier, like a CEO of a laundry company or an HVAC company, I'd have said, really? That's it? But when I started out, four things about me. One, Army, veteran, U.S. Army, military taught me something about discipline, teamwork, leadership. Two, engineering. Engineering made me a meticulous planner. Three, GE, in the golden era of General Electric, back in the Camelot era, I call it, when Jack Welch was CEO. GE taught me how to run a business. And then four was just experience. But when I was first, the phone started ringing. I'm at GE. I'm a manager. I'm working at the world's most admired company at the time. I'm thinking, hey, life is good. I'll be here for my whole career. Recruiters started calling. It's about the time you're getting towards the GM level that recruiters start picking you off, and hey, you want to come work at this private equity backed service company? And I'm like, what the hell is private equity? I didn't know what private equity was. Nobody knew what private equity was, because 21 years ago there were only a couple hundred firms, not 6,000, and only a few hundred billion in assets under management, not 5 trillion. And so I didn't know what private equity was, but I was chasing money and title, and it was my first opportunity to become a president and a CEO of a business. And so it was chasing money, chasing title, kind of got me started with private equity. And then I started learning more about it, over a 21-year period of being a CEO, and putting all those comforts of the technical background and career aside that I had, and just kind of charting a new course.
I always like to ask a question, and I usually ask it later in the show, but with you, I'm really curious. What do you know now after 21 years that you wish you'd have known day one of working around private equity? There's got to be something like, man, I wish I'd have learned this a long time ago.
Yeah, intensity and speed. I call working with private equity uh, the epitome of business. You can certainly aspire to be a Fortune 500, CEO or something like that. But when you think about, as a percent of the employee population, how many people in the Fortune 500 world earn seven figures, a year? It's a really, really, really small number. When you go back to kind of middle market private equity backed companies, and what's the percent of people that are earning seven figures a year? Much higher number. And so there's a lot of wealth being created in the middle market by private equity firms. But in order to generate that wealth, you really have to take, what is a slow growth, mature company. Each company that I've run had been in business for about 40 years before I got there. And so you're taking something that's growing at the single digits, and you have to instantly bend the curve, get it to grow at about 30% a year, and sustain that for a good 5 years or more in order to generate the private equity sized returns that they're known for. And so I think if I could have learned one thing earlier, it was just the speed at which change needs to happen.
What does it take to exit to a private equity company? Like, what is it like? What are they looking for, right? What's the entrance criteria? Like they're looking I hear different things from different mentors, and I've asked different people. I've asked mentors on the show what they're looking for. I'm really interested in what they're looking for.
Well, so first of all, 6,000 firms. So private equity is gigantic, lots of money, lots of capital. Right now, this very second, while people are watching this, there's 1.5 trillion in capital committed out looking for a company to buy right this second. So they're organized kind of in silos, and you'll have small private equity firms with small funds, who buy small companies and they grow them a little bit and then sell them to the next size up private equity firm, who then grows it, again, sells it on to the next kind of, and you could go through that two or three times. Like the inflection points, first of all, everything revolves around EBITDA. So, buyout funds, which are the biggest chunk of private equity capital, not venture. Venture sexy, but venture is a small piece of the overall private equity world. Buyout funds are where all the action is. That's where the mature companies that are real companies with real revenue, real earnings, are bought and sold. And so starting at about $1 million of EBITDA up to about 10 million of EBITDA is what I call kind of the first tranche.
So what they're looking to do is they need to grow their EBITDA up to 1.5, is what you're saying. One to 1.5 minimum to get in the door. What other requirements are there? Are there any other um, uh,
So, capability of growing again for a company to hit private equity sized returns, and let's just identify that. That's really 3 to 4 times multiple of invested capital. If you invest $1, you want back $3 or $4, and you want that probably within a normal 5-year hold period. So, what does it take to do that? It takes about 30% sustained, or total growth, about 30% in earnings. It can have various components. So it could be you're growing strong organic, but it's 12%, not enough. A company that's growing at 10% a year, it takes 7.2 years to double in size. A 2x multiple of invested capital, that would be a really bad return from a private equity perspective. And so to get it to a 4x return, got to grow at 30%. So, some of the things private equity looks for is fragmented market. So a lot of small companies in the United States and elsewhere are service businesses. Think about, if you're old enough to remember, before, remember a phone book? Yeah, yeah. Remember the yellow pages of a phone book. Here's how I like to think about it. If you could go into any city in the country and grab an ancient yellow pages and look at the yellow pages, what kinds of companies would you find? You would find landscapers, different parts of the country. You would find dentists, you would find veterinarians, you would find, all kinds of services type businesses, HVAC, plumbing, electricians. And if you can go to every city of the United States and find these kinds of companies, but they're not the same, they're all owned by different people, that's what you would call a highly fragmented market.
My question is what is the time that a management team has to be running the entity? If you build something like that over a 3-year period, there's got to be some time frame where they said, okay, they've built this, they've run it for the last, I don't know, X number of months, 12 months, 18 months. They're still growing. Yeah, we're interested. Or do we have to, like, where because was our timeline realistic in the fact that we thought we could sell it to a P&E firm at the end of the 3-year period?
Sure, absolutely. My shortest time running a company for somebody before I sold it was only 27 months,
Okay.
and it was a 4 times multiple of invested capital. So it was a really nice return in a very quick amount of time. And most private equity funds are rated in this thing called IRR, and it's expressed as a percent of return. There's a time element involved, so less time is actually better. If you can show strong growth over a short period of time, then that's really attractive, because again, we want 30% sustained growth. And if you've already you're on that trajectory, boy, that's sexy. Not only is it okay that it's not a long time, but it's also going to trade for a very high multiple, because they're coming in already on that growth trajectory that's needed to quadruple the earnings in size, over a 5.2 year period.